Joining us from Chicago to analyze Bernanke's comments, Lincoln Ellis. He's CIO at Strategic Financial Group in Chicago. Lincoln, always good to see you. Let's start off first with the U.S. markets, because we saw early gains in the wake of that China rate cut, but those gains sort of petered out as the day went on. How do we explain the loss of momentum?
Yeah, it was interesting, really, overnight. A bit of a tug of war, really, and it continues to be this tug of war between what's going on in Europe and what's going on in Asia. We saw futures after a significant rally the day before, overnight, rallying up off the back of a fairly decent Spanish bond auction, and then came off. And sure enough, about 6 a.m. Eastern, on the news of that rate cut, the S&P gained 5 full handles and continued to rally throughout the afternoon. But as the day went on, people began to ask the questions that you were asking of your previous guest, whether or not a rate cut like this actually is a very bad signal. And so we gave back all of those gains and then some. And the question really remains, what can policymakers do that is long-term effective, and where should investors be allocating resources right now?
So we saw the China impact on the U.S. markets, but of course the U.S. Fed Chief Ben Bernanke was testifying before Congress as well, and basically he said we do have further options for easing, but he wouldn't specify what they are. So what was the market reaction to Bernanke's speech there in his testimony, we should say, in Washington?
I'm not so sure how familiar viewers in Asia are with the Peanuts cartoon, where the teacher talks, and the sound that the school children hear is this sort of wah, 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 wah. This, of course, is the sound of Ben Bernanke telling us that he has more tricks up his sleeve and more monetary policy that will actually be effective. There simply is nothing more of any great significance that the U.S. Federal Reserve could be doing. They've had their foot on the gas, fully on the gas, for the past 3 years. It will take some time. This is a question of time, not monetary or fiscal policy, as global imbalances really work themselves through the system, both in terms of labor, production, and, of course, the all-important consumption as it pertains to U.S. As well as global investors.
And Warren Buffett has said he expects the U.S. to avoid another recession as long as the European debt crisis can be contained. Do you think Buffett's going to be proven right, or how worried are investors like you in the U.S. about what's playing out in the Eurozone right now?
I think investors need to continue to be quite concerned about what goes on in the Eurozone. I think the real fact of the matter is that if something actually breaks in the Eurozone, it will make the mortgage-based crisis that we saw in 2008 look like a warm-up game or a Division II soccer game. This is a very serious situation with very large both structural and legal ramifications that would grind large parts of the world economy to a halt. That said, and if you can bracket as an investor that risk, and it is a tail risk, I think Mr. Buffett's probably right. The U.S. economy continues to sort of hum along at a very low level of productivity and a low level of job creation, and that is to be expected. And I think investors understand that now, that is to be expected on the backside of the great contraction of 08 and 09, and people are being much more cautious about when and where they allocate those resources.
Lincoln, we have to leave it there, but appreciate your insights on what is yet another busy day in the markets. Lincoln Ellis of Strategic Financial Group joining us
Good to be with you, Seth.
Chicago.